Well, in fairness to Stripe, they were very honest about this. And they were like, we overestimated, got confident, and we overhired. And they found that all the coordination costs, to Sax's point, became too high. That's exactly what the Collison said in their memo. So I think that they're trying to course correct and get back to this. I think the point that I'm making unemotionally, I don't own Stripe nor Adyen. I don't have a horse in this race, is more that in this market specifically, in these middlemen, highly transparent middlemen markets, it's very difficult to hide the cheese, meaning the ability to get to an extremely precise valuation model is pretty easy. This was half a day's work that we did. And the point is, all this data is out there. And so it means that if you're going to go public as a company like this, you have to be quite thoughtful about how outside-in folks will value you, because the terminal buyer is very, very sophisticated and pretty smart about how to think about spaces like this.
Freeberg, when you look at this, it kind of dovetails with the Get Fit, Brad Gerstner, Elon at Twitter doing more with less employees. Zuckerberg again says he is getting rid of managers. He's asking managers, to Sachs's discussion about the layers of management that got added, where high performers would have 5 people put under them, 10 people put under them. Is it going to be, are you impressed with how quickly the industry is responding to this new environment, or are they not responding fast enough in terms of headcount, revenue? Because now we're looking at revenue per employee. I think this really never looked at that. It's been a decade since we looked at that.
This is a little bit of a different situation where it's about the scalability of a business. Like when I look at like the value that a business has created, you start first with like, can you make a product? Can you sell the product? Do people want to buy the product? And then, can you make money selling it? And then there's this metric that a lot of people use, which is LTV to CAC, which is the lifetime value of acquiring a new customer divided by the cost to acquire that customer. But I think you can generalize that ratio to talk about business performance more broadly, which is, capital deployed, which is typically what CAC is used in terms of growth on the denominator, and then capital returned over time, which can be the numerator. And so, you can kind of think about that LTV to CAC ratio being something more broadly defined as something like ROIC or what have you. The question for the scalability of any business is, does that ratio, whether it's LTV to CAC or ROIC, return on invested capital, does it get bigger or smaller? Does it increase or decrease? Does that ratio increase or decrease as you get bigger, as you spend more money, as you deploy more money? If it's getting smaller, then mathematically, you can resolve pretty quickly to the asymptotic valuation that business will achieve, or the asymptotic revenue that business will achieve. And that's a very scary kind of circumstance when a business that's tracking that metric starts to see that metric shrink. If that metric is growing, then you have a hyperbolic kind of moment, and you can build platforms and add products and invest very heavily and take lots of risk and take lots of bets. When it's going the wrong way, you have 2 options. Number 1 is you have to make a change or a pivot in the business to get it to go the other way. Or number 2 is you have to take advantage of that moment before the market finds out about that moment. Because as soon as the market realizes that ratio is going the wrong way, your valuation multiple, what you're worth as a multiple of revenue or profit, shrinks dramatically. Because then the market can also see that asymptote and outcome. So I think it's very often the case that one should, as a board member, as an investor, urge entrepreneurs, CEOs, founders, managers to think really clearly about that metric. What's the right way to define the denominator and define the numerator in our business, and define that ratio over time? And as soon as it starts tracking the wrong way, you have a moment. You can either fix it, or you got to go sell the business or go public and raise capital before the market catches on and your valuation shrinks. So I think what Chamath is highlighting.
Yeah.
So when I see what Chamath's showing in this data and talking about the shrinking valuation issue for Stripe, it really, I think, highlights this important point, this broad point, which is, did they miss the window? Did they miss the moment where suddenly, the shrinkage is causing, an asymptotic outcome for this business that it makes investors a little bit like, well, I'm not as excited about that because there's no longer as much upside. And it might be time to kind of devalue the company. And did they miss the moment to go public, raise a bunch of capital, to go and try new things and hopefully pivot into a way? So I don't know enough about the business, but that's my broad kind of assessment of this moment.
The interesting thing about that space, we talked to one of our friends at our poker game who runs a large consumer-facing business. And I don't know if you were there for that conversation off Freeberg, but
I was.
You were there, yeah. And one of the interesting things he said is we are at a level of scale where we just bid these guys against each other, and these things tend to now be loss leaders for them, which is to say effectively that cost structure becomes really important. So your CAC becomes very important because your LTVs are capped, right? And the LTVs are capped because these companies have enough negotiating leverage to say, well, if you want my business, here's the cost of doing this business, which makes a ton of sense if you're any large purveyor of services that require payment processing infrastructure. So one of the interesting dynamics I think we're learning in this market is how it's really not a market, right? There are segments and there's embedded profitability in each segment. So to your point, Freeberg, this is the sum of at least 3 or 4 different LTV to CAC ratios, right? The tail looks very different, which is why you have to build a ton of features. And the head just wants pure play, and it's all about cost first. Because all of these guys want to pick up every nickel and dime that's on the floor, because for them, on billions of transactions is meaningful to them. It's an EPS miss or beat, right, for them, which has huge implications to their stock. This is a market that I think is going to be really fascinating to uncover and peel back the layers of over the next few years.
By the way, we haven't even talked about what Stripe does as a business. I know we have a diverse audience that doesn't all come from tech.
Yeah, so Stripe will process your transactions, but they were the first people to make it as simple as putting a snippet of code into your app to process a payment. They compete with Visa, MasterCard, and those other places. They charge you a percentage of each transaction. So to Chamath's point, these larger, and so developers 5-10 years ago loved this because they could instantly add payments, right? It sort of abstracted the whole thing, just the same way cloud computing does, right? Storage at S3, et cetera. So you can kind of think about it that way. But a large whale in the system, Chamath, which you said Adyen has a lot of whales, not a lot of long tail. Stripe, because it's developer friendly and a snippet of code, they have this huge long tail. Anybody can do Stripe. In fact, people who are using things like Substack or Patreon, I believe, they can just drop in their Stripe account. So people now, businesses of one, have a Stripe account. They just drop it in there. So for me, that seems like huge potential in the future because some of those could become the whales in the system.
And the long tail gives Stripe a lot of pricing power because there's no way for any one of those entities to have enough leverage to tell Stripe, hey, I don't want to pay 2.9% plus 20 or 30 cents a transaction.
Right.
Whereas if you go to the head, I think Adyen is charging like 1.3 or 4%. So yeah, it's a wholly different market. And the pricing as a result is totally different.